Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, there's a lot to unpack today.
There really is. I mean, if you're a beginner investor trying to figure out where to put your money right now, you're probably getting, completely overwhelmed by all these conflicting signals.
Oh, totally. The confusion is completely justified.
Right. Because looking at the headlines, you see the NASDAQ just hit a 13-day winning streak.
Which is the longest since 1992, by the way.
Exactly, the longest since 1992. And the S&P 500 is just sitting at record highs. But under the hood, the debt market is telling a totally different story.
It really is. And I think to frame the big picture here, we have to look at the broader economy. Navigating the current landscape under the Trump administration, the U.S. economy is actually vastly outpacing Europe.
Yeah, looking at the data, the projections are pretty stark.
Very stark.
Cool.
We are looking at a projected 2.3% growth for the U.S. in 2026.
And Europe is at what, 1.1%?
It's exactly. A really sluggish 1.1%.
Yeah.
So because of that gap, U.S. assets are highly attractive globally right now.
Yeah.
But, and this is the core theme of our deep dive today, where you put your money inside the U.S. market has literally never mattered more.
Yeah, because we are looking at a deeply divided, almost schizophrenic credit market. According to recent analysis, the best way to visualize this is like a massive skyscraper.
I love that analogy. It works so well.
Right. So up in the penthouse, you have this pristine, sunlit environment where the biggest tech giants are throwing this historic borrowing party.
Yeah, they're just living it up on the top floor.
But then you take the elevator down to the basement, and the concrete foundation is actively crumbling under the weight of this murky thing called private credit.
That skyscraper visual is the perfect way to understand the systemic risk right now. So, let's start up in the penthouse. We are seeing an unprecedented corporate bond issuance boom.
Yeah, the numbers are wild. According to the research, Barclays is predicting that total U.S. corporate bond issuance could hit $2.46 trillion in 2026.
That is trillion with a T. It's a staggering amount of money.
But the shift here is who is actually doing the borrowing, right?
Exactly. Historically, it would be massive banks or, legacy industrial companies. But today, it's the AI hyperscalers.
Right, the big tech guys, Alphabet, Amazon, Oracle.
Spot on. Alphabet recently raised over $31.5 billion globally.
Wow.
Yeah. And Amazon raised $37 billion in the U.S. market alone.
And the craziest part of that data was that investor demand to buy that Amazon debt actually outstripped the supply by 4 times.
4 times. People were practically banging down the doors to lend Amazon money.
Okay, but let's unpack this for a second because it sounds a bit counterintuitive for a beginner investor. It's like a billionaire taking out a massive mortgage just because the bank is practically begging them to take the cash.
That's a great way to think about it.
Right. Like if these tech giants already have mountains of cash from their regular businesses, why on earth are they borrowing tens of billions of dollars more?
Well, to understand that, we have to talk about how the bond market works. Specifically, how yields interact with spreads.
Okay, let's break that down into simple household terms.
Sure. So when you buy a corporate bond, you are basically acting as the bank. You are lending your money to Amazon.
Right. I give them cash. They promise to pay me back with interest.
Exactly. And that interest rate Amazon pays you is made up of 2 distinct parts. The first part is the base rate.
Which is set by the Federal Reserve, right?
Heavily influenced by the Fed, yes. It's the baseline cost of borrowing money in the economy. Right now, that base rate is hovering around 3.50 to 3.75%.
Okay, so that is just the absolute minimum floor for borrowing money anywhere.
Correct. Then you have the second part, which is called the spread. The spread is like this little extra bonus interest you get paid for taking on the specific risk that Amazon might go bankrupt and, not pay you back.
Oh, okay, so the spread is essentially my hazard pay.
Yes. Hazard pay is the perfect term for it. And right now, the spread your hazard pay for lending to massive tech giants is tiny. It's practically zero.
Because the market views these AI hyperscalers is completely risk-free, right?
Exactly. They have endless cash flow.
Yeah.
They dominate their industries. They're building all the AI infrastructure.
But wait, if the hazard pay is zero, why are investors fighting to buy these bonds? Why was there 4 times more demand for Amazon's debt?
Because the total payout, what we call the absolute yield, is still really attractive. Even with a tiny spread, when you add it to that Fed base rate of 3.50 to 3.75%, investors are looking at a total return of over 5%.
Oh, I see. So for large institutional investors or even just everyday retail investors, getting a 5% return without taking on any real default risk is amazing.
It's a dream scenario. The investors get this incredibly safe 5% yield, and the AI giants get all the cheap capital they need to build, massive data centers without having to drain their own cash reserves.
Okay, so the tech giants are effortlessly soaking up billions of dollars at 5%. It's a total win-win for everyone up in the penthouse.
It really is.
But, and here is where we pivot, that massive vacuum of capital at the top has to have a consequence, right? It starves smaller companies of affordable credit.
That is the exact causal link,
Yeah.
and that forces us to take the elevator all the way down to the basement.
Right, down to the basement. And the recent analysis had a brilliant analogy for this. They said the current market looks like adding an 11th floor to a 10-story building.
It's so true. The foundation just wasn't built for it. And that foundation is made of private credit.
So let's define private credit for the everyday investor listening. Because public bonds, like the ones Amazon issues, those are traded openly, right? I can check an Amazon bond price on my phone right now.
Yes, exactly. But private credit operates in a completely different universe.
How so?
Private credit involves direct loans made by investment funds to mid-sized companies. We are talking about regional software providers, mid-tier manufacturing plants, or maybe a large national gym chain.
Got it. So normal, everyday, mid-sized businesses.
Right. And these loans are totally private agreements. They are not publicly traded on any exchange. There's no ticker symbol you can look up.
And bringing in the macroeconomic data here, those mid-sized companies are sitting right on the fault line of the U.S. consumer economy.
They absolutely are.
Because looking at the data, February retail sales did tick up slightly, but consumer sentiment, which is how people actually feel about their finances, just crashed.
Yeah, to a record low of 47.6.
Right, 47.6. That is a brutal number.
It really is. And if we connect this to the bigger picture, many of the companies relying on private credit are in highly consumer-sensitive sectors.
Like that gym chain you mentioned.
Exactly. When consumer sentiment crashes to a record low, it tells us discretionary spending is going to dry up. People cancel their gym memberships.
Right, they tighten their belts.
And here's the real squeeze. The private credit loan that Jim took out probably has a variable interest rate.
Oh, wow. So as the Fed kept base rates high to fight inflation, the gym's interest payments automatically went up, exactly when their revenue started going down.
It's a total vice grip on their profit margins.
And the data is definitely reflecting that stress. According to Fitch, the default rate for U.S. private credit borrowers is projected to hit a record 9.2% in 2025.
Yeah, that number is alarming.
Let's just pause on that. 9.2%. The private credit market is huge. A nearly double-digit default rate isn't just a tiny rounding error.
No, it represents billions and billions of dollars in loans that are simply never going to be paid back. The foundation of the skyscraper is actively cracking.
Which leads to a massive logical paradox for the beginner investor. Let's say I have money parked in a private credit fund,
Okay.
and I hear that default rates are skyrocketing to 9.2%. My immediate instinct is to sell my shares and get my cash out, right, before the fund takes a massive loss.
That's the rational move, yes.
But according to the research, I actually can't do that. The funds are actively blocking people from withdrawing their own money.
They are.
It's wild. It's like showing up to an ATM, asking for $100 of your own checking account money, and the machine says, best I can do is $5, check back next quarter. Right. How is that even legal?
It's legal because you agreed to it when you invested. It's usually buried deep in the fine print. They call them redemption limits or redemption gates.
Redemption gates. Okay.
Yeah. Private credit funds sell investors this amazing narrative. They promise high returns with incredibly low volatility. It sounds like a magic bullet.
But there is a catch.
A huge catch.
Yeah.
The trade-off for that supposed stability is liquidity. You are legally restricted from pulling all your money out at once.
And the data shows this isn't just some theoretical emergency button. They are pulling these levers right now.
Oh, absolutely.
BlackRock's HLEN fund had $1.2 billion in withdrawal requests recently, but they only paid out $620 million. They literally gated half the money.
Yeah, and it's not just BlackRock. Blackstone, Blue Owl, Carlyle, these are some of the most prestigious financial institutions in the world. And they're all restricting investors from getting their cash out fully.
That is a major red flag.
It tells us a quiet panic is already underway. But to understand why they're trapping the capital, you have to look at that illusion of stability I mentioned.
Right. Why do these private credit funds claim to have such low volatility in the first place? Why don't the prices bounce around every day like normal stocks?
Well, it's not because they are safe. It's because of a mechanism called Level 3 accounting.
Level 3 accounting.
Basically, because these direct loans aren't traded publicly, there is no daily price discovery. Nobody knows what they're actually worth on a given Tuesday.
So who decides what they are worth?
The fund managers themselves. At the end of the month, they use internal models to value their own assets.
Wait, really? They're basically just grading their own homework.
That is exactly what they're doing. Grading their own homework. Imagine you bought a house for $1 million. A year later, the market crashes, and every house on your street is selling for $700,000. But instead of accepting that, you just write on a napkin every month, my house is still worth $1 million.
So if you only look at your napkin, your wealth looks totally stable, zero volatility.
Exactly. But that stability is a complete fiction.
And the second you actually try to sell the house to a real buyer, the fiction evaporates. You have to face the real price.
Right. So bringing it back to private credit, if these funds actually let investors withdraw that $1.2 billion at the ATM, the fund would have to sell those underlying loans to get the cash.
Ah. And selling them on the open market would force actual price discovery. Buyers would see the 9.2% default risk and demand a huge discount.
Exactly. The fund would have to formally write down their assets, the illusion of low volatility would die, and even more investors would run for the exits. By putting up gates, they prevent the fire sale.
They just keep the napkin math alive.
Precisely.
That is incredibly precarious. But here is the plot twist from the data. Wall Street isn't stupid. They know what's hiding behind those gates.
They absolutely do.
And they are starting to force the issue. On April 10th, S&P launched an index that includes business development companies, or BDCs.
Yeah, BDCs are a vital link here. They are publicly traded companies whose whole business model is making private credit loans.
Yeah.
It's basically a backdoor for everyday retail investors to get into private credit.
Right. So S&P launches this index, and suddenly big banks start trading credit default swaps, or CDS, against private credit funds.
Yes.
And a credit default swap is basically Wall Street's version of fire insurance, right?
Very much like fire insurance. If you think a private credit fund is holding parable loans and is going to blow up, you buy a CDS. If the fund collapses, the bank pays you a massive sum of money.
Okay, but I have to ask about the ethics here. The reporting shows JP Morgan alone has $50 billion exposed to this space.
Yeah, they are heavily involved.
The big banks helped build this entire private credit market, and now they're turning around and selling fire insurance against it burning down. Are they just playing both sides?
Well, banks are in the business of managing risk and generating fees. They always play both sides. But what's fascinating here is the structural shift this causes.
How so?
By creating these CDS products, Wall Street is finally forcing a public price tag onto these hidden, opaque Level 3 loans.
Because the cost of the insurance reveals how much danger there actually is.
Exactly. If banks suddenly start charging you $10,000 a month for fire insurance, they are publicly broadcasting that your house is currently on fire.
Right. So anyone can look at the price of a credit default swap and see in real time exactly how much risk the market thinks is hidden inside that fund.
It completely bursts the opacity bubble. When a market that relies on secrecy suddenly gets a real-time risk premium attached to it, things can unravel very quickly.
So are we looking at a repeat of the 2008 financial crisis then?
Not quite 2008, because in 2008 there were immediate margin call that forced overnight fire sales.
Right, the whole system just froze up instantly.
Exactly. But here, because of those redemption gates, the ATM refusing to give you your money, the funds can't be forced into an overnight fire sale. The lockups prevent a sudden crash.
Okay, so what does the unraveling look like?
It's going to be a slow-motion stress test. Companies will slowly default, funds will slowly write down assets, and investors will slowly realize their money is trapped. The stress is just publicly visible now.
Man, that is grim. So what does this all mean for the everyday beginner investor listening right now? Let's bring it all home with some actionable insights.
Absolutely. I think there are 3 clear rules for the current market based on the data. Rule number 1, don't be fooled by the stock market.
Yeah, just because the NASDAQ is breaking records doesn't mean the whole financial system is healthy.
Exactly. You have to separate public stock optimism from the reality of private debt.
Which naturally leads to rule number 2, right? Stay in the penthouse.
Yes. Stay in the penthouse. If you're buying bonds or credit ETFs, stick strictly to investment-grade public bonds from massive tech and financial companies.
Because you can lock in around a 5% yield with incredibly high safety, there's no reason to take on hidden risks.
Exactly. Which brings us to rule number 3. Avoid the basement.
How does an everyday investor even accidentally get into the basement, though?
Usually through high-yield ETFs or dividend funds. Be extremely cautious of alternative asset managers, unlisted BDCs, or any fund promising high returns with, quote, low volatility.
Because a low volatility today basically just means illiquid and opaque.
Spot on. You do not want to find out your retirement income is trapped behind a redemption gate.
That is such crucial advice. Stick to transparent public assets and let the giants fight it out in the murky depths.
Yeah, the friction from putting a public price tag on private credit is going to be immense.
Which leaves us with a really unsettling thought to mull over. If private credit is finally getting a public price tag, what happens when thousands of everyday retail investors realize the stable returns that were promised for years were just an illusion of slow accounting? Will the next financial panic start not on a chaotic stock exchange floor, but in the obscure, illiquid corners of private lending, where people simply log into an app and realize they can't get their own money back? It's something we all need to be watching closely. Don't forget to subscribe and hit that like button.